Well, the Fed can say whatever it likes, but the bond vigilantes, particularly around the 10-year, they can do whatever the hell they want. You saw the 10-year go through 1%. My prediction is that it's going to end the year at 2%. So 100% increase on that just from the bond vigilantes. And that really doesn't affect your anything about equities, because equities don't get hurt until you can trade a 10-year at 3%. That's when guys take money off the side and park it in a treasury risk-free, make 3% a year. They don't care about 1 or 2%. But we're not going to get that next year. But the point is, anything with long duration, any kind of like a utility stock, that's going to suffer as rates slowly go up. And the reason they're going to go up, even though the Fed keeps its hand steady, which they've said they're going to, is that people are watching $2 trillion fall from the sky from a helicopter, and that basically is inflationary at some point. It's, money for nothing and chicks for free for the next 3 months. They're pouring money into the American economy like they've never done. This new $1,400 check plus another $400, that goes straight into people's pockets and in many cases into the market. So you're going to see a lot of volatility.
And I want to make sure we reiterate that point that you made initially. Is there a number, as far as a percent number is concerned, that we should have in cash to be able to take advantage of some of these opportunities?
Yeah, I mean, I think if you're, you have your core holdings because you don't want to miss the big up days. And as we just talked about last year, that happened across 19 days, which is really concentrated. But I like to have, when I know I'm going to be going into volatility, up to 20% in cash to take advantage of really big down days. So you can sprinkle a little, if you get a big correction, as we saw happen in the energy sector last year, and you put some money to work, you've had a hell of a rebound there. Now, maybe you're taking it out of there again because we just saw the bad news coming out of Exxon, the whistleblower story, Biden saying he doesn't like hydrocarbons. So you got to be nimble. You got to be nimble. But I like 20% cash in a vol year like we're about to have.
So give us, you've already mentioned a couple, but give us your thoughts. What group, what area of the market should we be focused on that maybe might be under the radar a little bit at this point?
Well, one thing you got to think about when you're talking about a 10-year moving from 1 to 2%, or even it goes up to 175, what's your inflation hedge? Are you a gold guy? Are you a Bitcoin guy? Do you like other cryptos? What are you doing to trade inflation? Because you got to have a strategy. And so, maybe you play the GLDs. Maybe you go with Frank Holmes. He's got a couple of royalty-based Go AU. I mean, I own some of that too. But the point is, I like to be in a year like this, 5% weighted in gold. Now, a lot of people are talking Bitcoin, and that's interesting too, because it continues, to go. I think it's about 800 billion, almost $1 trillion market cap. The only issue, because I know we're going to talk about Bitcoin, let me lay something on the table for you got to consider. There's a lot of talk that institutions are endorsing Bitcoin. That's not exactly true. I'll give you an example. The big story last year in Q4 was the PayPal trade. The idea that PayPal was now taking Bitcoin as a currency to actually purchase product. But what they're doing actually is immediately mark to marking. Bitcoin comes in, that split second, they turn it back into USD. They take no risk on Bitcoin. They are not going long Bitcoin. They're not endorsing Bitcoin. They're just allowing it for you to trade it on their platform back into cash, because every vendor that sells something on there wants it in US dollars. The other myth is that somehow a big money center bank like a Goldman Sachs or JP Morgan is telling clients to buy Bitcoin. There is I can't find a single discretionary fiduciary. In other words, you're running grandma's, $1 million portfolio. You're putting her 5% weighting in Bitcoin. That is not happening. Where there's discretion, they're not taking that risk because the regulator hasn't made a ruling. Not in Germany, not in Europe, not in England, not in Switzerland, not in China. And so the risk you would have is if you have somebody in 5% on a discretionary basis in Bitcoin, and all of a sudden the regulator steps on it and you get a 30, 40% correction, you're part of that class action suit. So be very careful in the assumption, because everybody in the Bitcoin world, the Kryptonians, the Bitalorians, they're all telling you that this is now a mainstream institutional product. No, it isn't.
Let's approach this from a little bit of a different angle then, Kevin. You've made your opinion on Bitcoin, very well known in the past. Is there a way that we might be able to get exposure to this market, cryptos in general, from an equity standpoint that we need to be aware of?
Well, the big one that people are waiting for is the Coinbase IPO. And that's going to be interesting because it's the first big infrastructure into crypto. And the talk of the town is it's going to be another hot IPO. The only risk, because that will be a pure equity play, the only risk is that it's going to be highly correlated to one currency, Bitcoin. And Bitcoin, unfortunately, even though people talk it up as an alternative to the market, as a counterweight to the market, it's highly correlated to the market. When the market corrects, Bitcoin corrects even more. So we haven't seen that alternate, sort of bias. In other words, go long Bitcoin when the equity markets are correcting. So what I anticipate will happen is you're going to get the Coinbase trade. It's going to come out. It's going to be hot, but it's going to be volatile as hell. And because it's going to have market volatility and Bitcoin volatility, because none of the other currencies over the last 3 years have made a difference. Nobody cares about them. Bitcoin's the trade. I think battery technology, Elon is going with lithium, others are talking hydrogen. I think battery is the whole story. There's also the consideration, is lithium going to become a scarce commodity? There's lithium mines in Canada. These are all the big issues of the day around EV. EV's here to stay. EV market share will continue to grow. Tesla's, in my view, fully valued. I mean, that thing is valued beyond a car company. It's a data company, it's a tech company, it's a battery company, it's a solar company, it's everything. And maybe that's okay. But at the end of the day, there'll be lots of other SPACs going into EV, and every single car company, if it wants to stay in business, is going to have to do something in EV. And I think the play on EV, and even the Apple play, if you think about it, because all of the talk of Apple going into EV is, it's us in Canada, it's Magna. Who's going to supply all the parts for all of these different players? So the way I look at it is, if you want to get into EV at a decent multiple, you just go long some Magna and see what happens. Now, they're having a change at the top. Don Walker's checking out. New guys are coming in, but that's okay. Walker did a fantastic job in that company in the last few years. But to me, that's your baseline hold on EV, because you're not going to pay some stupid multiple, and Magna's profitable.